Right. Good day, good morning, good evening, good afternoon. Welcome on behalf of Sullivan and Worcester London's office to what is going to be the last webinar of 2024. As you can see, it's headed looking back to look forward in trade finance. I'm Geoffrey Wynne. I'm going to kick off, and if you like, this is my chance to comment rather more freely with my own views about last year, this year rather, and the year ahead. But I'm also joined, I'm pleased to say, by two of my partners, Marian Boyle, who heads our dispute resolution department, who's going to talk a little bit about arbitration, and Mark Norris, who heads our ECA practice, who's going to talk about ECAs and DFIs. So what are we going to talk about? Next slide, please. I'm just going to give you my thoughts on was 2024 memorable? You may disagree, but it'll give some food for debate. Incidentally, if you've got any questions or comments, there's the Q&A. Please feel free to type them. I'm going to look at the bad and the good news, what was done, by whom and to whom. Marian is going to talk about how to solve your disputes, and I have to recognise that we do every so often have disputes in trade finance. Mark's then going to talk about ECAs and DFIs, including adaptation finance, which is an interesting product. And then I'm going to have a look forward to 2025 with some themes and ideas. Next slide, please. First question, was 2024 memorable for trade finance? Well, in some ways, I would say not really. If I were marking trade finance, I would say perhaps it could have been better. Why? Well, there were good and bad reasons, lots of them. And of course, the conflicts and politics, no need to list them, was not good for trade. But what did it do for trade finance? Not a lot. It slowed it down a bit. And it just didn't seem to expand as, if you like, how I would have hoped might have happened in relation to particularly emerging markets, particularly involving other parties. The trade finance gap widened, as many have said. Why? And I would say there was just too much focus on the developed markets. And that's a theme that I think I will run through what I'm going to talk about and hope that we can break through. But what it meant was that there were many interesting transactions, but were they just different structures or different methods? Were you actually doing the same thing with the same parties, just doing it differently? Did we get beyond proof of concept in a lot of what we were doing? Perhaps a few did, but not many. Did trade finance fail to deliver? I think so, yes. There were many reasons. Regulation, uncertainty, I might suggest lack of support, perhaps from the insurance market, certainly from the rating agencies. So what holds trade finance back is a question. Next slide, please. Trade finance is still too risky, seen as such by some, notwithstanding the view that those of us working in the market have that trade finance is a good product. There is still a perception that there are risks. Have the risks changed? Well, my original slides of many years ago looked at three risks: performance risk of the obligor, country risk of where the obligor was, and payment risk of the buyer. Since then, of course, other risks have been added, particularly things like reputation risk. But if you have a good commercial transaction, that should be financeable. So therefore, has risk appetite changed? And for whom? Well, I think the problem remains that for many, particularly, I'm afraid, the banking sector, is that trade finance is available only for some customers, the same customers, with just variations of the structures that are available. So one of the questions that I want to consider is, where would you find new participants? Well, we know from discussions that investors are available who would like to look at trade finance assets. But the question is, have we embraced enough suppliers and buyers to join, if you like, the way forward in trade finance? More explanation is needed. And one of the points is then, what have we been telling them? The same initiatives have been continuing. There's an increased focus on getting trade financed, but a recognition, I'm afraid, that not all trade can be financed, is being financed, or indeed is financeable. So why? Next slide, please. I still regard that there is a continuing regulatory obstacle for banks and beyond. Basel 3.1, which is moving forward in the EU and will be moving forward in the UK, as you'll see in a moment, I think it provides more uncertainty than certainty. It continues to reflect a lack of understanding of trade finance and the need for it, and the need for major banks, other banks, regulated entities to be involved. One of the net effects of Basel 3.1 will be increased capital cost for the larger banks. I think we can assume that those banks will still do supply chain finance, but with whom will they do it? And will they do it in a lesser amount? What will the cost be? Equally concerning is the regulator's misunderstanding of credit insurance. I'm disappointed that the treatment of insurance companies as initially treated just as a corporate risk, but still not treated with the way that many of us would have hoped they would be treated. And that's potentially going to make it not as capital attractive as it might be. And therefore, there are more problems than solutions that Basel 3.1 will demonstrate. In addition, the late payment regulation or directive, which we all thought we had dispensed with, is still around. What's it all about? Well, there's an argument that says it protects working capital. If the seller or the supplier can get paid more quickly, that helps him. But of course, it doesn't help the buyer if he's got to pay more quickly. Yes, it might be able to help, but the supply chain finance product, I have argued for years, is a good product. And the consequence of that is we need flexibility. We don't need mandatory requirements. And let me just finish this bit off with saying the accounting treatment, particularly for supply chain finance with the new requirements of IFRS and equivalent, does not help trade and supply chain in particular. And the same old argument about trade debt or bank debt. We want trade finance debt to be trade debt. It is not bank debt, and yes, it does matter. Next slide, please. So in a little bit more detail, the EU CRR, most of it comes into force from the 1st of January. In the UK, the PRA wanted more time, and so we have another year in the UK. One of the key highlights is lower capital requirements for certain instruments, mainly letters of credit and performance guarantees may get better treatment, but it's difficult to analyze it, as many of you will know. What is interesting is the UK is planning to remove the short-term tenor, in other words, the less than 1 year, as a consideration for CCF treatment. That would be good news. But there's been a lot of consultation in relation to the impact of increasing CCF, and to be honest, not very much improvement has really been made in the overall trade finance product. That's disappointment. Next slide, please. Is fraud on the increase? Well, the answer is that's a perception. But the possibility of fraud in trade finance transactions is always there. But the methods invariably remain the same. Non-existent goods, double financing of goods, double invoicing, selling the same receivable twice. One of the worries that I've had is that letters of credit, which is a very good tool for payment, may be a good tool for facilitating frauds, because the requirement of UCP is that you deal in documents only. And that is a bit of an issue that perhaps the ICC might want to consider, because there are clearly solutions available to prevent fraud. Due diligence is the classic on a transaction, better systems within banks in particular to try and detect fraud. There are lots of fintech products around. A cynical comment came to me that some of the fintech products could be solutions to non-existent products, but equally there are a number of very good products available to assist with fraud detection. I put LEI down, legal entity identifier, because I do think that that is one of the keys. If you can identify the parties, that will help a lot. I'm going to let Mark initially kick off on ESG and sustainability as a rollout, as a requirement, because is it causing a slowdown in traditional trade finance? And I'll come back to that later on. Next slide, please. I have to say that corporate failures within trade finance in its widest sense don't help the perception of trade finance, whatever they are, from the old ones going back to Abengoa, to Carillion in the UK, to Greensill, which is still mentioned, all having very different reasons for their problems, to more recent ones like Sten, would point to increasing concerns. But my question is, why should that, or has it affected trade finance more widely? It should not, but there are clearly issues, including reputation risk, that will cause parties not to want to participate in trade finance and trade finance assets. Next slide, please. Now, some good news. There's some very interesting products assisting trade finance. Growth of receivables through a number of different platforms. Other ideas, as I will get on to a bit later, in supply chain finance and beyond. Some interesting legislation to remove potential barriers. Everyone's talking about Melita, the model law on electronic transferable records, translated into a number of jurisdictions, including the UK with the Electronic Trade Documents Act, France, and so on. There are more potential players, originators who embrace trade finance transactions and investors. What we need to do is to turn the potential into actual. And I would at this point say there has been some very good work by the ICC, by ITFA, by BAFT and others to widen the appeal of trade finance. More liquidity is clearly available. From where and for what reason? And I'll look at some of that shortly. But before I get into my look to the future, let's have some thoughts initially from Marian on disputes and then from Mark on ECA and DFI. So Marian, over to you.
Thank you, Jeff. So just continuing, I think this is a good news theme. While we all accept that disputes are a very unwelcome distraction, they obviously do happen. And London continues to be considered the foremost centre for international litigation and arbitration. But I've got particularly good news for you if you like to have your disputes resolved without the added pressures of press and market scrutiny. And if you prefer to have control over the process, then arbitration is your natural choice. And it has the added benefit, some would say it's the preeminent benefit of ease of enforcement, because as we know, arbitration awards are easily enforceable in New York Convention states. I think there are over 170 signatories now, so that clearly puts it head and shoulders above the enforcement of judgments. But we see arbitration as part of that wider mutually supporting network of international business that includes trade, banking, insurance, legal services. And because the English Arbitration Act is now over 25 years old, it's a 1996 Act, we thought that in the arbitration community, it'd be sensible to revisit it in order to try and help preserve this reputation we've got as a preeminent arbitration jurisdiction. So the law commissions were asked to review the Act, and pleased to say that following consultation, the generally accepted view was that it works well and major reforms aren't needed. So that's good news. But the Law Commission did think there were some recommendations of targeted areas of reform. And so the overarching aim of this new legislation is to ensure that the Arbitration Act is fit for purpose going forward, and it continues to promote the efficient resolution of disputes by arbitration. And of course, the UK as the leading, if not one of the top 2 leading destinations for arbitrations. If we've got any Singapore attendants, I suspect they are vying for that place. If I could have the next slide, please, Trish. So I'm going to just briefly touch on 6 major areas of reform in the bill, starting with a new default statutory rule to determine the law governing the arbitration agreements. Why do we care? You might think, well, it's really important to care in order to avoid wasting costs, because there's uncertainty in the absence of parties' choice. And parties sadly very often fail to specify what they are choosing as the law governing their agreement to arbitrate. So going forward under our new Act, it will be the law of the seat unless parties choose otherwise. There is an exception for where your arbitration agreement arises from a treaty or from non-UK legislation, but that will be the general default rule. And just as a reminder, the seat of the arbitration determines the legal system that provides the arbitration procedure and determines which courts have supervisory jurisdiction over the arbitration. So it's clearly vital for international arbitrations where the parties are likely to come from different legal systems, and they choose London as a neutral venue to have some certainty as to what laws might apply, because different governing laws will give different answers to important questions like, for example, does the agreement to arbitrate extend to a subsidiary company? Or if there's a challenge to the arbitrator's jurisdiction, to question whether the dispute is even capable of resolution by arbitration, that would be governed by different systems of law, because in some jurisdictions, as a matter of public policy, certain disputes have to go to the courts. So this new default rule will avoid all that uncostly satellite litigation that effectively just decimated your legal budget without actually advancing your dispute. And it will, this certainty will be most welcome in the arbitration community. So the second major change relates to arbitrators' impartiality. The bill codifies the arbitrator's common law duty to require an arbitrator to disclose circumstances that might reasonably give rise to justifiable doubts as to their impartiality. So it extends to circumstances not only of which the arbitrator is actually aware, but circumstances of which they ought reasonably to have been aware. So I think it gives parties who choose London to arbitrate greater confidence about the standard of disclosure their arbitrators would be held to, and for that reason is a welcome change. The third area of reform is strengthening arbitrator immunity around the rules on resignation and applications to remove arbitrators. So going forward, arbitrators won't be liable for their resignation unless they're resigning in unreasonable circumstances. And they won't be liable for any costs of any application to remove them unless it shows they've acted in bad faith. So the aim of that reform is to support the arbitrators to make robust and impartial decisions without actually fearing that the party who is disappointed, shall we say, by the decision might vent that disappointment by suing the arbitrator. It's an immunity that judges already enjoy, so and for similar reasons, so very welcome. It should now apply to arbitrators. Fourth area of change is a new power for arbitrators to summarily dispose of issues that have no real prospects of success. I think this is a really useful reform, particularly, for example, financial institutions. If they're involved in an arbitration where they think the respondent has no real defence to non-payment of the debt, it will be most welcome that they have an opportunity to get that heard quickly and get it disposed of quickly without the full hearing that would otherwise be required. So fifth area of change I want to look at is clarifying the court's powers against third parties in support of arbitral proceedings. Without getting down in the weeds, there was some difference of views as to whether those powers already existed, but this will put it beyond doubt that the court will have powers to make orders against third parties to support arbitral proceedings and to support emergency arbitrators. So, as you probably know, the court already has the power to make interim orders in respect of, say, taking of witness evidence, preserving evidence, preserving property, interim injunctions, and that sort of thing. The new act will make it clear that those court orders are available against third parties. So it might be an order made against a third party who holds relevant evidence, or, for example, against banks that hold relevant funds. And so this better aligns the position of arbitration proceedings with the position that would apply in courts. And allied to that, the emergency arbitration rules have been developed by many arbitral institutes since the 1996 Act was passed. So there's a gap in the law. These emergency arbitration rules enable parties to obtain urgent protective measures, to preserve property or to stop evidence being dissipated. And the new act will give sharper teeth to enforce orders made by the emergency arbitrators, so basically give more teeth to them. And then finally, we're going to have a revised framework for challenges to the tribunal's jurisdiction. So this is where a party has objected to the tribunal's jurisdiction during the arbitration, and the tribunal has ruled on that objection. So going forward, those challenges will be much more similar to an appeal rather than a full rehearing. And that's another driver driven by cost efficiency and to discourage objecting parties from having two bites of the cherry. So again, another really welcome change promoting the efficiency of arbitration. So next slide, please. So what's our timetable for this lovely new act? The optimistic amongst us had hoped we'd have it before Christmas, but I'm afraid the Parliament's Christmas recess begins in a couple of days' time, so it's not likely we'll get royal assent on it until the new year. But I think we can all look forward to those changes to English arbitration law. It will help parties to obtain fair resolution of their disputes by arbitration without unnecessary expense, without unnecessary delay, and it will better align the powers of the arbitrators with the power of judges. So overall, I think that's really welcome news for 2025. So as ever, if you want to discuss any of the relative advantages and disadvantages of arbitration or litigation as a means of resolving your dispute, we'd be happy to help. We love that sort of debate, and the pros and cons are very interesting. So do please get in touch. And with that, I'd like to hand over to Mark Norris. He's going to look at developments in the likely direction of travel in export credit agency and DFI arenas. Thanks, Mark.
Thank you. Trish, can we have the next slide, please? Thanks very much, Marian. Thank you, Jeff. In the export credit and DFI space, I mean, certainly 2024 has been very, very interesting, and certainly the last quarter, there are a lot of things that have happened that will certainly set the direction for 2025. I mean, Jeff did touch on ESG. I mean, that continues to be an issue, and actually when you just look at the impact of climate, 2024 was pretty stark. I mean, we're on track to be the warmest year on record. We've actually gone above the 1.5 degrees Celsius above pre-industrial levels. So very much a stark year from a climate perspective. Export credit agencies and DFIs do have a critical role to play, not only in supporting trade, but in terms of what the wider impact of climate, be that mitigation. And when I talk about mitigation, it's looking at those projects and transactions that look to reduce carbon in the environment. So that's projects such as solar projects, carbon capture, and adaptation finance. And the adaptation finance is financing transactions that look to make economies more resilient. And certainly adaptation is financing is actually key to much of trade, particularly around post-harvest agriculture. So there's a lot of overlap in terms of what we do from a trade finance perspective and an ECI, DFI perspective. So it's certainly been an interesting year. I don't think it's, in terms of the climate change, no sign of it peaking and damaging impacts. But on a positive note, we've seen a lot of, we know that people are focusing on this. If I could have the next slide, please, Trish. One thing that's slightly, it was certainly something that is controversial and that expired at the end of last week, was that there's a reduction in the OEC down payment requirements. And think about export credit agency finance, and is that there tends to be a lot of jargon out there, but that it does actually underpin transactions and can have quite significant impact on proposed transactions. For export credit agencies within what are called the participant countries, that's Australia, Canada, EU, Turkey, UK, USA, there's an arrangement that governs how those countries provide their export credit support. Now, it was the case that in terms of providing support, export credit agencies could provide support of up to 85% of the financed value of a contract. When COVID hit, it was recognized that there needed to be more flexibility, and that down payment requirement was changed from 85 to 95%. So that meant that export credit agencies could finance 95% of an export credit contract. So that was very much welcome, but it was very much a stopgap measure. It was introduced in 2021, and over the past few years, it's been extended on a yearly basis. Could I have the next slide, please? So the original, what was termed the common line, which was this change to the down payment from 85 to 95%, was effective to 2022. It was extended in 2022 to 2023. Last year, it was extended for a further year, and that was because the UK argued that for a lot of the emerging and developing economies, access to finance was still an issue. And we saw that because countries were suffering from rating downgrades, default, and importantly, the impact of climate change with flooding and droughts. The December 23 extension expired last Friday, and it doesn't look like it hasn't been renewed, and there's a question mark whether it will be renewed. And this is something that we'll be watching closely, but if it's not renewed, then it means that for export credit agencies, they can only finance up to 85% of the export contract value. It's an interesting, this percentage leads to a lot of debate, because there are arguments that it squeezes out African banks in particular from providing that support for the 5 or the 15%. But there is a lot of support from exporters that export credit agencies should be able to provide support for up to 95%. And interestingly, in a recent UKEF sponsored paper, although it doesn't represent the views necessarily of UKEF, the paper, which I'll touch on later, did argue that being export credit agencies being able to provide 95% cover of the export contract value was important and very much welcome. So that's something that's expired this year, and we're looking to see whether it will continue. Could I have the next slide, please? One thing that's been recognised is that the funding gap, and I think Geoff touched on this earlier about the issue around liquidity and trade finance. Where is all the liquidity going to come from? There's also a challenge in the export credit agency and DFI space, because there's clearly a big need for financing projects, and particularly those projects around adaptation finance and sustainable development. And in the trade space, issues around financing post-harvest agriculture, so the warehousing, the silos, the testing, is seen very much as being critical, not only in terms of ensuring that there's more on the continent that I focus on, inter-Africa trade, but also ensuring that agriculture is resilient to climate change. What is clear is that, and I think in the past, there was a split between the DFIs and the export credit agencies. What we've seen and what is being recognised is that actually that split can't be allowed to continue. So in October of this year, we saw the Bern Union and Finance in Common, and Finance in Common represents the development banks such as Africa Development Bank, the World Bank, launch a joint initiative to promote greater collaboration. And what very much underpinned that is the need to mobilize capital to meet the United Nations Sustainable Development Goals. So as we go into 2025, we can look to expect much more collaboration between the export credit agencies and the DFIs, and that's certainly something we see internally, particularly with the DFIs looking to provide support for trade finance. Could I have the next slide, please? I mentioned earlier that UKEF had commissioned a report. The report came out in November, and it looked at social infrastructure and the OECD arrangement. And it's a very well researched and detailed report, and it's very interesting the themes that have come out of it, because although we may actually think that ESG is dominant, one thing that was clear was there's not been enough collaboration between the DFIs, the development banks, the export credit agencies in looking at how you can meet the various sustainable development goals. I think this is very much coming to the fore now. So what it means for us as practitioners and the export credit agencies, development banks, and banks that are listening to us, we can expect much more collaboration going forward. And that collaboration, I think, is not going to be just about how we can meet the sustainable development goals, how we can meet the adaptation finance, but also overlaying that, how we can meet the trade finance objectives. Could I have the next slide, please? Excuse me. So this is just picking up on my last point, but it was very much an interesting quote that came out of the UKF sponsored reports. How I'm very much emphasised the point that the official export credit agencies haven't been involved enough with the UN Sustainable Development Goals. And so certainly as we look into 25, we expect much more collaboration. Excuse me, my throat is drying out here. Next slide, please. There's as always, there seemed to be a lot of fanfare about COP29, which was in November. Certainly a lot of there were a number of positives that came out of that. There was a finalized carbon market agreement that allows carbon trading on a bilateral basis. That was very much welcomed. On adaptation and mitigation, it was recognized that the progress there was limited. We've now moved into a cycle where the COPs are going to happen on an annual basis. So what we are certainly going to see in 2025 as we approach COP 30 is a greater focus on the adaptation. And as I mentioned earlier, the adaptation finance is how do you finance the hospitals, the post-harvest agriculture, the water, the irrigation. That was something that was lacking in COP29. And as we go into 2025 and COP30, we expect that being very much at the fore. So from an export credit agency and DFI perspective, what we're going to see is certainly more collaboration and a greater focus on adaptation finance. Could I have my next slide, and I'll hand you back to Geoff.
Mark, thanks very much. Audience, thank you I've already seen some questions coming up. We'll deal with the questions at the end. Still time to add some more. Just a warning, Marian, there's a couple for you there. As well as Mark's optimism, I think there are many positives as we go into 2025 for trade and consequently for trade finance. One of my questions is, the way ahead is digital, which is a question mark with an exclamation mark, because I think that is certainly one of the ways forward, and I'll have a look at that in a moment. There are new products that the inventiveness of the finance community is doing well. Cynically, I might say, these are revamp of some of the old, but it doesn't really matter because if we can make the market more accessible, and that's accessible for those who need the finance, i.e. the suppliers and the buyers, and to make it more accessible to the financial institutions, that will certainly accelerate the closing of any of the trade finance gap. It's still time for the regulators, but only just. If they could just listen to what we are saying about why trade finance is held back, because there are plenty of ideas, there are plenty of opportunities, but are there too many concerns that stop that happening? Next slide, please. A lot of talk about those two words at the top, digitization or digitalization. As I see it, and as has been explained, digitization is literally a digital alternative. And that's been possible for years, from electronic signatures. And consequently, what it will do is to speed up some processes, potentially make them more secure, but allow the resort to paper should you need it. And in some ways, you could stop at that point and say, well, that's fine. You know, I will do what I want to do, and I don't need to go any further. But of course, what everybody really would like to see is digitalization, which is the end-to-end digital transaction. So a trade transaction from start to finish would be digital. And in some ways, when I was part of the uniform rules for digital trade transaction, when we assumed that matching data would trigger a sale and a payment obligation, some thought we were ahead of our time, some thought that we were mad. But the phrase "say no to paper" is the mantra that is really being put forward, although accepting, I think, that human intervention is going to be needed. There's a lot been going on proof of concept, but where do we go from here? Can we roll this out more, and by whom and of what? Next slide, please. My congratulations to the ICC, who listed a series of key issues that I've set out for you. Interoperability of systems, how important is it? Well, yes, it might be, but it's not necessary if you're happy with a platform or whatever that you're working on. But the idea of this ecosystem allowing essentially e-customs, e-payments, e-finance, and e-identities that I've mentioned before, they're going to be important if we really are going to get to the digitalization of trade. ICC, amongst others, are trying to create some data standards to put those in place on trade corridors. Governments are signing up amongst themselves how they will react to effectively the digital age. Watch this space, it's happening. But the question, as many have heard me say before, is this evolution or revolution? And I would still say this is evolutionary, that the revolution we may have to wait for. Next slide, please. What's interesting in the UK, that there's been a discussion and the property digital assets, etc. bill, when it becomes law, as we hope it will look at property in the context of digital assets. And it will create a third category which will enable digital assets to be considered property. The courts will define what will qualify that, but for trade finance, this can mean ownership of electronic records treated as property. And that will be an important move forward into the digitalization of trade. Next slide, please. So as I said, digital trade should increase. The continuing adoption of Melita into legal systems. As I mentioned, our method of doing this through the Electronic Trade Documents Act created essentially two key areas which were very helpful for trade. The first was digital payments, and the second was digital assets, as I just mentioned. There are platforms and players who are using electronic promissory notes and electronic bills of exchange. But even with the changes of law, there are complications that are being raised, which some of us are trying to overcome. We're working on this to make it work. But there are many varieties of electronic payment undertakings, electronic invoices, and so on. But conceptually, unless and until we can get more buyers to embrace the use of these products, we don't actually expand the market. Because it's fine to say, well, an electronic promissory note is an electronic promise, an unconditional promise to pay a sum certain. Unless the buyer is prepared to issue that, to accept that it will pay, and I won't bore you further, but I leave you with that point, that's how we need to expand things. There's clearly a growth in the electronic bill of lading market, but quite honestly, electronic bills of lading have been around for years, 25 plus years, but in what I describe as a club environment. If you sign up to a platform, you can agree mutually to recognize an electronic bill of lading. Outside the club, you don't, but the holder of that electronic bill of lading has then a right to convert that into paper at discharge port and so on. So it's been possible. So all the heralding of we're doing this should be looked at in the context. It will happen, and it is one way of moving things forward. The UK, ironically, the other digital asset that we created was electronic warehouse receipts. Although in the UK itself, warehouse receipts are not regarded as documents of title. And remember that conceptually, you need to make sure that whatever we create electronically exists as a document of title to the underlying physical goods. Next slide, please. There's another innovative, and I put that in quotes, product, because some herald this as a solution for all, Some say it will never happen. Is it pre-export finance in another guise? Well, not quite. So what is deep tier supply chain finance? Very good paper from BAFT and the Asian Development Bank, which looked at this in the context of post-shipment financing only. The basics of DTSCF, an anchor buyer, in other words, a party of, if you like, undoubted credit, who agrees that it will issue some form of IPU, in other words, an irrevocable payment undertaking to pay for goods when delivered to it. And the deep tier looks at the tier of suppliers. And if you consider it conceptually, tier one is supply chain, is the supplier, the direct supplier to the buyer. So the deep tier takes it back beyond that tier one supplier into tier two, three, and so on. And the question then is, how deep can you go? Can you go cross-border? What are the issues? Could you only do it post-shipment, or can you do it pre-shipment? In other words, in an emerging market, for example, with perhaps a key question in relation to the anchor buyer. Does he know his supply chain? How far is he prepared to let his payment obligation go back to allow financing down the chain? And I would mention I'm part of an ITVA initiative that looks to see if we can widen and explain deep tier supply chain finance. Watch this space. Let's move on, please. Next slide. Other products, I see discussion about the growth of inventory finance. Interesting idea, great help to buyers if you can structure it correctly. So you have a party intervening between a supplier and a buyer who owns the goods, which then get taken down by the buyer, saving the buyer's cash flow, securing supply. How to do it is a little bit challenging. There are complications, because if you are financing inventory, you want to know that you have somebody that's going to buy it from you. If you're the buyer, you clearly don't want that obligation to buy on your balance sheet. So we have to work our way around it. More about that, I'm sure, on another occasion. The next point, syndication of receivables and payables. That was just something I picked up as a discussion, but the idea is perhaps instead of having individual suppliers and buyers, we might have a portfolio approach, a pooling of receivables and payables, which create a better risk and financing appetite. That will be an important way forward, particularly for investors who want diversification, not a specific payment obligation from a specific buyer. Can we expect more from the credit insurance market? I hope so. I'd like to see the credit insurance market go beyond the known credits in developed markets and perhaps move into the emerging markets to encourage appetite from investors. I'd like to see rating agencies being less conservative, and just ask the question of, is it essential to have a rating of every single piece of paper representing a trade finance asset? I think I would argue no. Others will argue it differently, but these are just some structural points to look at. Do DFIs hold the key? Will Mark help a little bit? There are plenty of opportunities. There are DFIs who are really exploring getting involved more and more in the emerging markets, recognizing the strength they have to cover certain risks that will make financing in trade more attractive. Next slide, please. A drawback, it seems to me. The Financial Stability Board published a report recently with policy recommendations, at the moment limited to derivatives and the securities markets. But the report is part of a program which it says is to enhance the resilience of non-bank financial intermediation. but looks at liquidity, risk management, stress testing, ensuring sufficient collateral is available. My concern here is that if the result of this is to impose on NBFIs the same strictures that are imposed upon major banks, we will not get the expansion in trade finance that we might otherwise need. I just park that for you. Next slide, please. Mark talked about ESG. My issue for this purpose is there too much emphasis on the environmental bit of ESG? If that is the case, is it the end of financing upstream carbon products, for example, which are needed in the emerging markets? And I've heard and agree with those who are saying a reset is needed for the emerging markets. You cannot judge the emerging markets by the same standard as developed markets. We need different standards. We need to realize what is needed in those markets, where it may well be that oil and gas, other carbon products remain necessary for the economies. And remember the S&G, the social and the governance part, in the availability of finance. So some key themes. Last slide, please. There are innovative solutions available. Many of you will be developing them. The idea is that we can unlock trade finance for the emerging markets. That, if you like, is a crusade for 2025. Credit insurance, listen, DFIs, please carry on. Bring in the non-bank investors. Again, there's an ITFA initiative called ITFI, which is explaining trade finance assets to non-bank investors. Somebody suggested are there too many fintechs around? Do we need a consolidation of fintechs? Or should we just work out what solutions we really need on that? There clearly will be an increase in the digitalization of trade, and that's good news. I'm optimistic about 2025. I hope that you will all be as a result of this. But remember, trade finance is a great product. Wherever the description is, whoever uses it. But the key, it seems to me, is that we can all talk about finance, but we have to bring along suppliers and buyers, because they are, after all, what trade is. And if we don't have trade, we have no finance for it. So I would say happy trade finance solutions, happy working in trade finance. And of course, I wish you a happy new year, but let me deal with the questions first. Let me start off. Somebody asked, what's the exact Basel 3.1 issue with credit insurance? It's the treatment of insurance companies, where many of us argue that they clearly should not be treated as companies. So the regulators turned around and ultimately said, well, okay, apply a 50% risk weighting to them. Better than it could have been, but not as good as perhaps it should have been, if you consider that 20% might have been a better risk weighting for them. Somebody asked, what's the reason that Greensill failed? No, it wasn't. I don't regard it as fraud by directors or management. I simply regard it as they were selling a product that was not supply chain, but they were selling supply chain as if it were. And it was all about future receivables that hadn't even been created and potentially might not have been created. There's nothing wrong with doing future flows. Absolutely not, because that's what pre-export finance might be all about. But I think you have to describe it correctly to those who are involved in it. And that's part of the reason that I and others support getting clear definitions on that. Marian, you've got 2 questions.
Okay, so top arbitration locations for trade disputes, common and civil law. We're slightly hampered by the fact, which is a fact I like about arbitration, is that it's a private process. So unlike the courts, where they generally publish their numbers and we know how many disputes they are hearing, and we know which divisions they are, and we know whether they involve international parties, parties who want to resolve their dispute by arbitration tend to want to keep that quiet, because that's one of the joys of arbitration rather than litigating. You don't have the press all over your back, and you don't have your competitors seeing what trouble you've got into over a particular contractual issue. So we can only go on the stats that are published. In connection with the reforms of the Arbitration Act, we do know that London is at least equal top with Singapore, and on some studies, the top arbitral jurisdiction, so where parties would prefer to have their arbitration seated. But after that, civil law, I honestly don't know. Not aware of any stats on it. I would guess that it would be France, because the ICC has their location there, but that is just a guess. Then the next question is, what's my best guess as to when the arbitration changes will become effective? I'm hoping very soon in the new year. It's a very uncontroversial bill. It's going through the special procedure because it was promoted by the law commissions, and they follow a different process. So they get introduced first to the House of Lords, and then they go to the Commons. So I'm hoping this is now a tick box exercise. But when we last looked at the parliamentary website, we were no wiser. So I'm hoping early 2025. It's a little present for us all, but not sure.
Next question was more favourable capital costs for green financing. Could it be embedded in Basel? Well, the answer is yes, of course it could. But Mark, any thoughts? What's the discussion going on green financing?
Well, certainly, I think one of the challenges with green financing is the amount of compliance one has to do in terms of the reporting requirement. So actually streamlining, so in terms of reducing costs of projects, actually streamlining the reporting and reducing those burdens would go a long way, I think, to reducing costs. I mean, I think part of the challenge from a capital perspective is the taxonomy about what actually constitutes a green financing, green projects, and we've seen issues come out certainly quite recently around greenwashing and carbon credits. So I'm not sure whether, in terms of from a regulatory capital perspective, it's going to be an easy ask, but I think there are easier things around it, particularly around the reporting requirements and reducing those to take some of the costs away.
Thanks. The next question is a wonderfully cynical question. There's not been any fundamental innovation in trade finance world for 25 plus years. I'm not sure I would necessarily agree with that. But in some ways you're right that whatever we do, it's not so much to reduce the payment risk, just to clarify the payment risk on an obligor, to deal with performance risk. And there's a suggestion that the trade finance community should do better to provide better data to show that trade finance assets are less risky. And I agree with that. I've been pleading with that since Basel II, let alone Basel III and Basel 3.1. I tend to operate at a mantra that trade gets paid, which is why structurally trade transactions should get better treatment. But that's still an argument that's going on. One more question. Innovative financial products. Do you see any barrier to bring liquidity? Well, the answer is that what we're trying to do is to create a class, if you like, of trade finance assets as we define them, that will become attractive to the investor, but consequently asking for the regulator to walk down this path with us, whether it's short term, where we see some improvement for short term letters of credit, for example. So we still got a way to go. But as I say, my mantra of trade gets paid should, I hope, encourage all of you to look at expanding your involvement in trade finance. We've sort of run over by a minute or two. I see no more questions. I think we've dealt with all of them. So can I thank my fellow panelists, Marian and Mark? Can I thank you all for listening? and wish you happy holidays and happy transaction conduct for 2025. And we will be back with the next webinar in probably the end of January.
Thank you. Happy
Thanks
New
a lot.
Year.
Thanks.